Welcome, dear traders. Asian stock markets rose today following a 2% increase on Wall Street yesterday. A sell-off triggered by the CPI data release did not last long. Stocks rebounded sharply. Shares climbed thanks to a strong technical support levels and a drop in the volume of short positions. Traders are cautious because of a high volatility fueled by a sharp trend reversal, and there have been no fundamental events that could improve risk appetite. On the contrary, given the fresh inflation figures, the Fed might even start raising rates more aggressively. Some analysts reckon that stubbornly high inflation may force the central bank to hike rates at a faster pace for a longer period of time. If so, it will be bad news, as this step may cause a global recession. Meanwhile, Asian stocks are recouping losses amid Friday's rebound. The US dollar is hesitant to pick up a trajectory due to the strange market reaction to the CPI report. The yen is sliding down today as the Bank of Japan has made only verbal interventions so far. Investors were puzzled by the fresh inflation figures. Nevertheless, they believe that consumer prices are highly likely to drop sharply in the near future. It appears they remain optimistic despite market pessimism. It has already happened many times. A rebound occurs amid a short-term wave of optimism. It ends rather quickly, and an upward movement is followed by a steep decline. This scenario is likely to take the place once again. As the reading was rather strong, the majority of investors factored in a 75 basis point rate hike at the November meeting. The chance of the same rate hike in December totals 71.5%. And now almost all analysts are sure of it. However, some of them expect a more aggressive rate hike by 100 basis points. The likelihood of such an increase amounts to 9%. The gap between the yields of 2-year and the 10-year Treasury bonds widened, further inverting the yield curve. The spread was 51 basis points. An inverted yield curve is usually viewed as an indicator of a pending economic recession. Currently, many countries are teetering on the verge of a recession. Even China is dealing with this challenge. Today, the country unveiled its inflation report for September. China's consumer price index, the main gauge of inflation, grew by 2.8% on an annual basis. Inflation is mostly fueled by high food prices. In the first 9 months of the year, the index climbed by 2% compared to the same period last year. According to the official forecast, by the end of the year, consumer prices will total 3%. Last year, inflation in China was 0.9%, although the government expected a 3% rise. Market sentiment in China improved significantly today as the central bank promised more stimulus measures for the real economy, which is only dependent on investment. The World Bank unveiled that investment in China's GDP is almost 20% higher than in other countries, while household consumption is almost 20% lower. The Communist Party is scheduled to have a meeting soon, given the high youth unemployment level close to historic lows. The real estate crisis and the struggling debt levels. Xi Jinping needs to revise the economic model that has been facilitating economic expansion for 4 decades. Now it seems unreliable and outdated. The US dollar index was trading flat during the Asian session amid high volatility. Nevertheless, it managed to settle above 112 points after a sharp drop in the previous session. A rally that was expected after unexpectedly high inflation did not happen. However, investors may resist what's happening. Besides, more traders priced in a 75 basis point rate hike next month and in December, despite a rebound in the stocks, which affected the US dollar. The US dollar declined significantly versus the euro and the pound sterling. The latter also benefited from speculation about a shift to a new stance by the Bank of England. The greenback advanced against the yen after hitting a three-decade high overnight, despite the talks about Bank of Japan intervention. The US currency is sure to recover and sail higher as the US economy remains resilient despite the headwinds in the global one. The US dollar index is likely to rally until the global economy starts showing green shoots of recovery. In the meantime, the US dollar remains the most popular safe haven asset, as speculators may get bigger profits from it. The target level is located at 120 points and the index may jump to new highs after breaking through 114, which currently acts as a strong resistance level. It could complete its correction after reaching the range of 111.50 and 112.00. Meanwhile, the yen keeps depreciating. The USD JPY pair advanced above 147.00. There was also a short-term breakout of 147.64. As a result, the Japanese currency plummeted to its lowest level since August 1990. The Bank of Japan has pledged to maintain an ultra-loose monetary policy even though other major central banks stick to a tighter stance to cap inflation. Bank of Japan Governor Haruhiko Kuroda stressed the need to support the economic recovery after the pandemic crisis. The regulator aims at achieving the 2% inflation target in a sustainable and stable manner. The finance minister confirmed yesterday that the government is ready to take decisive measures against speculative moves of the yen. He also noted that the bank pays attention to the speed of forex moves, not annual levels, when deciding to take action. In September, the Bank of Japan conducted the largest currency intervention in history to stem rapid falls in the national currency. A dazzling rally of the US dollar has made the pair extremely overbought. However, the upward momentum remains strong, thus the USD JPY may rise higher. It's gradually approaching the next resistance level located at 141.00 and 150.00. After reaching this range, the price is expected to roll back. The support level is located at the upper border of the range of 145.00 and 143.50. The Australian dollar is extending gains after breaking through the lowest level since April 2020, located at 0.6245 on Tuesday. The AUD-USD pair was trading above 0.63 during the Asian session. It rose amid increased risk appetite, and the pair also climbed thanks to a Beijing's pledge to provide more stimulus for its coronavirus-hit economy. Apart from that, the UK announced it could change the monetary policy stance, sending shockwaves through markets. And last week, the Reserve Bank of Australia raised its interest rate by 25 basis points to 2.6%, contrary to expectations of a 50 basis point rate increase. And the regulator has hiked rates by 250 basis points this year, saying that the cash rate has increased substantially in a short period of time. For this reason, it decided to slow down the pace of tightening. Nevertheless, the Reserve Bank of Australia will closely watch the situation. It may raise the rate more aggressively once again as inflationary pressure persists. The current recovery of the Australian dollar is quite fragile and may end at any moment. If the US dollar resumes an upward movement, the Australian dollar is likely to lose steam. Today, the US dollar may rebound thanks to a strong retail sales report, and it is expecting a bit reading given positive data on the car sales and a decline in the gasoline prices. This is why the outlook for AUD USD remains bearish. A breakout of a 0.60 level before the end of the year looks very quite possible. At the same time, the pair may hit the bottom when it approaches 0.60 and 0.61. Inflation data is still in the spotlight. If there are any signs that inflation has perked, it will be a positive fundamental factor for the US economy and the global one. Nevertheless, given the latest report, it's unlikely to occur in the near future. And that's all for now. Subscribe to our channel and keep your finger on the pulse, and see you soon.